Market structure is one of the most powerful concepts in trading, yet most explanations make it feel way too complex. The truth is, it's actually simple if you focus on what really matters. In this video, I'm going to remove all the confusion and share 8 key concepts that every trader needs to master market structure with confidence. But first, let's start with the basics. There are only 3 types of market structure you really need to know: uptrend, downtrend, and range. Let's keep it simple and break each one down. First, the uptrend. This is when price keeps moving higher. You'll see higher highs and higher lows. That just means buyers are in control. In this kind of market, the smart move is to look for buying opportunities when price pulls back. Second, the downtrend. Same concept, but in the other direction. Price is making lower highs and lower lows, which shows sellers are in charge. So instead of buying, you're looking for chances to sell and follow the trend. Third, the range. Price isn't really going up or down, it's just moving sideways between support and resistance. Buyers and sellers are basically balanced. This is where a lot of traders get stuck or take losses, because there's no clear direction to follow. Now here's the key point. Market structure is just the pattern of how price moves, whether it's making higher highs or lower lows. These moves reflect what people are feeling, things like fear, greed, and hesitation. When you understand these patterns, you'll have a better sense of what the market is doing, and that helps you trade with the trend instead of fighting against it. Now let's get into another important concept. Look at this strong move right here. Price is moving up fast, with big green candles, almost no wicks, and each candle closes higher than the one before it. This kind of move is called an impulse. It shows buyers are fully in control. And most important, price breaks above the previous high. That break tells us the trend is now going up. Now, here's what usually happens after a strong move like this. After that big push, price starts to slow down. You'll see smaller candles, some red ones, and maybe price moves sideways a little. The candles don't look as clean anymore. There are wicks, and price isn't moving as far with each candle. That's the pullback. It's just the market taking a small break before the next move. Here's the important part. Price doesn't fall below the last low. That demand zone is still holding. The market is keeping its structure. Then suddenly, price finds support and moves up again, making a new high. That's a clear sign the uptrend is still strong. Smart traders wait for this pullback to buy, not after the big move has already happened. Here's a common problem traders face. They look at a chart, and they're not sure if price is trending up, dropping, or just moving sideways. They try to mark zones or draw trend lines, but it still feels unclear. So how do you fix that? It starts with understanding swing highs and swing lows, the key points where price changes direction. A swing high forms when price moves up, then turns and starts falling. A swing low forms when price moves down, then turns and starts rising. For example, if price pushes up and then pulls back, that high point is a swing high. If price drops and then bounces back up, that low point is a swing low. Why does this matter? Because if price breaks above a swing high, it often signals that buyers are in control and the market could go higher. If it breaks below a swing low, it usually means sellers are taking over and the market may move lower. Swing highs and lows are like signposts on the chart. They help you see where price is turning and give you a clearer view of the trend. It's easy to spot a swing high or a swing low, but the real question is, will the trend continue or is it about to reverse? That's where 2 simple tools come in: break of structure and change of character. Let's start with break of structure. Imagine the market is in an uptrend. Price is making higher highs and higher lows. Then price pulls back a little and pushes higher again, breaking the last high. That's a break of structure. It tells you the uptrend is still strong. You can draw a line across the last high to mark it. Once price breaks and closes above that line, that's your confirmation. It means the market is still bullish. Now let's talk about change of character. This one tells a different story. Let's say the market was in an uptrend, but this time, price doesn't break the last high. Instead, it forms a lower high and then breaks below the last low. That's your change of character. It's the first clue that the trend might be changing. The uptrend could be over. The market might be turning bearish. So when you see a change of character, it's time to pay attention. You might stop looking for buys and start watching for possible sell setups. Here's the simple way to remember it. Learning how to spot these on the chart helps you stay one step ahead. You'll know when to stay with the trend and when it might be time to change your plan. Strong lows, weak highs, let's spot them on the chart. First, notice how the market is in a clear uptrend. You can see price making higher highs and higher lows. Every time price pushes up, it pulls back a little, then pushes even higher. That's a strong, bullish structure. Now, focus on these pullback points right here. These are what we call strong lows. See how price dips into these areas, but buyers step in and push it right back up? These strong lows act like support. The market respects them, and they help keep the uptrend alive. On the flip side, check out these highs. These are what we call weak highs. Price struggles around them for a bit, but notice how they don't hold for long. The trend eventually breaks right through.